Most people think that the riskiest thing you can do is put your money into the stock market. They see the red lines on the TV, they hear the shouting on the news, and they think, I'll just keep my cash in a savings account. I'll keep it under the mattress where it's safe. Let me tell you something. In 2026, that mattress is on fire. Back in 1981, I wrote a letter to my shareholders where I described inflation as a gigantic corporate tapeworm. I want you to visualize that for a moment. A tapeworm doesn't kill the host immediately. It just sits there quietly and eats the host's food before the host can digest. It doesn't matter how hard the host, that's you works. It doesn't matter if you get a raise or work overtime. The tapeworm of inflation preemptively consumes your purchasing power, regardless of your effort. We are entering a cycle in 2026 where keeping your money idle isn't just a bad investment. It's financial suicide. This isn't a prediction based on a crystal ball. It's a logical consequence of the cycles that govern our economy. Money in its paper form is an illusion. It's a yardstick that the government keeps shortening every single year. If you had $100,000 in 1980 and you kept it safe in a box today, that money would buy you what $30,000 bought you. Then you didn't lose the money lost its soul. To understand why 2026 is the moment of truth, you have to look at what just happened. Between 2020 and 2022, the United States printed more money than in entire previous history combined. Think about the gravity of that. More than 240 years of wars, industrial revolutions, and growth were surpassed in just 24 months of money printing. Now, that money doesn't just evaporate. It flows through a process we call the Cantillon Effect. Imagine I have a garden hose and I turn it on. The grass closest to the nozzle gets soaked first. The grass at the far end of the yard stays dry for a long time. In our economy, the nozzle is the Federal Reserve and the big banks. When they print $1 trillion, the people closest to that nozzle, the big corporations, and institutional investors get to spend that money before prices go up. By the time that money reaches your pocket in the form of a paycheck, the prices at the grocery store and the gas station have already spiked. You are at the far bend of the yard watching your grass turn brown while the people at the nozzle are swimming in a pool. Inflation is a systematic transfer of wealth from those who hold paper to those who own assets. It is a silent tax that no one voted for, but everyone is paying. Let me tell you the story of two families in suburban Chicago back in 1970, the Martinez family and the Thompson family. And both had managed to save $50,000 a king's ransom at the time. The Martinez family was prudent. They put the money in a savings account earning 5%. They thought this is risk-free. By 1980, their account had grown to $81,000. On the surface, their approach appeared successful. However, over time, rising living costs significantly reduced the real value of their savings. Even though their account balance grew, it ultimately bought much less than before. They lived modestly, avoided unnecessary spending, and saved consistently, yet their purchasing power declined. Another family chose a different strategy. Instead of keeping all their money in savings, they diversified it across income-producing assets such as rental property, shares in established businesses, and a small allocation to physical stores of value. This approach involved more short-term fluctuation, but over the long run, their total assets grew substantially. Their wealth didn't just keep pace, it increased meaningfully in real terms. Today, many economies face rising debt levels and long-term financial pressures. Governments generally have limited options to manage these obligations, and monetary expansion is often one of the tools used. Over time, this can reduce the purchasing power of idle cash. As a result, one of the largest financial risks is not sudden market swings, but leaving money unproductive while costs continue to rise. This leads to an important decision: whether to rely solely on cash or to place savings into assets that can adapt to changing economic conditions. Currency values fluctuate over time, which makes it important to think carefully about where long-term savings are stored. DNG. Many people assume success comes from frequent buying and selling, but during periods of rising costs, a long-term ownership mindset can be more effective. Assets that produce real value, such as land, businesses, or essential goods, tend to maintain their usefulness regardless of changes in prices. While the numbers on paper may shift, their underlying value remains. The key idea is to focus on assets with pricing flexibility. Businesses that provide products or services people consistently need often have the ability to adjust prices over time. In these situations, those holding productive assets are better positioned than those relying only on cash. If someone were building a long-term strategy today, a balanced approach could be considered. This might include established, profitable companies with strong brands, real estate or property-based investments that generate income, and a smaller portion allocated to tangible assets that historically retain value during uncertain periods. The goal is not speculation, but resilience, placing savings where they can continue to work rather than slowly lose effectiveness. Gold, silver, and energy. I've never been a huge fan of gold because it doesn't produce anything. It just sits there looking at you. But in 2026, as the debt hits $38 trillion, having a small percentage in, something that cannot be printed by a central bank is just common sense. It's insurance against the wheelbarrow scenario. Pillar 4, the opportunity, reserve 10 to 15%. Notice I didn't say zero cash. You need enough liquidity to sleep at night and enough to strike when the market panics. In 2026, there will be moments of extreme volatility when the idle money crowd panics and sells their great companies for pennies on the dollar. You want to be the one with the bucket, not the thimble. Before you buy any asset in 2026, I want you to give it the pricing power test. Look at this generic water. If the price goes up by 10 cents, you might buy the next brand over. That company has no power. Now, look at this Coke. If the price goes up by 10 cents, are you going to stop drinking it? Probably not. You'll grumble and then you'll pay. When money is being debased, you want to be on the side of the brands that people love and the utilities they can't live without. Yeah, okay, the Thompson family from part 1 didn't get rich because they were lucky. They got rich because they owned things that the world demanded regardless of what the Federal Reserve was doing. Idle money is a bet that the government will be responsible. History shows that is a very bad bet. Productive assets are a bet on human ingenuity and the fact that people will always need to eat live and be entertained. That is a bet I have, won on for 80 years. And it's the only way to win in 2026. We need to talk about something that the people on the evening news are too afraid to mention. You look at your bank and you see marble, floors, thick glass, and big vaults. You think that is where my money is, protected. But I want you to look past the marble. In 2026, the banking system is facing a silent crisis. Think about what happened when interest rates were near zero. Those banks took your deposits and bought billions of dollars in government bonds. They thought they were being safe, but then the world changed. Inflation spiked, rates went up, and the value of those old bonds crashed. Right now, hundreds of regional banks are sitting on massive unrealized losses. That's a fancy way of saying they are holding paper that is worth way less than they paid for it. They are praying you don't ask for your money back all at once. If they had to sell those bonds today to give your cash, many of them would be underwater. When you leave your money idle in a bank account, you aren't just losing to inflation. You are effectively lending your life's work to a system that is built on a foundation of crumbling paper. You are taking all the risk of a bank failure, but you're getting none of the reward. Does that sound like a safe bet to you? Let me ask you a question. Okay, when you put $1 in the bank, whose dollar is it? Most people think the bank is just a storage unit for their cash. It isn't. Legally, the moment you deposit that money, it isn't yours anymore. You have become an unsecured creditor of the bank. You've given them a loan. In 1930, when banks failed, people stood in lines for miles. Today, the lines are digital, but the math hasn't changed. If a crisis hits in 2026, the government has two choices. They can bail out the banks by printing more money, which destroys your purchasing power, or they can bail in the banks by using a portion of the deposits to save the institution. Either way, the person holding idle cash is the one who pays for the mistake. The system is designed to protect the gears of the machine, not the oil. You are the oil. You are being used to lubricate a system that is failing to protect you. I've lived through the Great Depression. I've seen the panic in people's eyes when the safe doors stayed locked. I'm telling you this not to scare you, but to wake you up. True safety in 2026 doesn't come from a bank's promise. It comes from owning things that don't depend on a bank's balance sheet to have value. I told you that cash is like oxygen. You need some to breathe, but you don't want to live in a room made of it. The silent crisis of 2026 is that the oxygen is being sucked out of the room by debt and bad bank portfolios. If you have $100,000 idle, you are the candle under the jar. Okay? You are watching your flame get smaller every single day. I want you to perform the oxygen test on your finances today and ask yourself, if my bank went on a holiday for 2 weeks, what do I own that still has value? Do you own a share of a company that people will still buy from tomorrow? Do you own land that will still grow food? Do you own a skill that the world is willing to pay for? If the answer is no, I only have a bank balance, then you are in the line of fire. The smartest thing you can do right now is to stop being a sitter and start being a doer. Don't wait for the headline to tell you the crisis has arrived. By then, the doors are already closed. You need to move your wealth into real space before the paper space evaporates. Now, we're going to look at the 2026 weather report. We'll look at the specific geopolitical and fiscal storms coming our way and why doing nothing is the most expensive choice you will ever make. I've spent 80 years watching the American economy and I've learned one thing: incentives are everything. If you want to know what a person or a government is going to do, don't listen to their speeches. Look at their math. As we sit here in 2026, the American national debt has crossed a threshold that would have seemed like science fiction when I started my career. We are at $38 trillion, but here is the number that should keep you awake at night. The interest payments on that debt alone are now costing us over $1 trillion a year. Think about that. We are spending more on past mistakes, the interest, than we are on our entire national defense. When a government reaches this point, they only have two doors to choose from. Door number one is to cut spending and raise taxes. That is politically impossible. It's like asking a room full of people to vote for their own root canal. That leaves door number two, inflation. You pay the debt back with dollars that are worth less than the ones you borrowed. For the government, inflation isn't a problem, it's the solution. But for you, the person with idle money in a bank account, it's a death sentence for your savings. But it's not just the debt. We are facing a silver tsunami. Every single day in 2026, over 10,000 Americans turn 65. They become eligible for Social Security and Medicare. These aren't optional programs. They are promises made to a generation that is ready to collect. The cost of these programs is growing automatically like a tide that never goes out. At the same time, the world hasn't gotten any friendlier. Global military spending has hit record highs, over $2.7 trillion. between the pressures in Europe and the competition in the Pacific. The demand for more defense dollars is relentless. Okay, so you have a government that must spend more on the elderly, must spend more on defense, and must pay $1 trillion in interest. Where does that money come from? They can't tax enough to cover it. They have to print it. When you keep your money idle in 2026, you are essentially volunteering to be the liquidity for this machine. You are holding the paper that they are printing in excess. You are the one standing at the end of the cannon line we talked about in part one, waiting for the crumbs while the value of your dollar is being vaporized to pay for these global storms. The most common thing I hear from people is, Warren, I'll wait for things to calm down. I'll wait for inflation to hit 2% again before I invest. Let me tell you, the market doesn't wait for you to feel comfortable. While you are waiting, the theft is happening in real time. If inflation stays at just 5%, which is a very conservative estimate given these pressures, your $100,000 becomes $75,000 in purchasing power in just 5 years. You've lost a quarter of your life's work because you were waiting for a signal that isn't coming. In 2026, the weather report is clear. It is going to rain paper. If you don't have a roof made of real assets, you are going to get soaked. Now, we're going to look at the lifeboat strategy. I'm going to show you exactly how to move your wealth from the sinking ship of idle cash into the assets that will not only survive this storm, but thrive because of it. We are going to look at the Thompson family blueprint for the modern age. When the government starts printing money like it's going out of style, you don't want to own a business that has to constantly buy new machines or build new factories just to stay in place. I call those capital hogs. In 2026, a capital hog is a death sentence because the cost of those machines will double every few years, eating all your profits. You want to own what I call royalty-like businesses. These are companies that require very little new capital but have the power to raise prices at the rate of inflation or higher. Take a look at a company like Coca-Cola or See's Candies. We bought See's decades ago. If the price of sugar goes up, we raise the price of the box of chocolates. People don't stop buying chocolates for their sweethearts because it costs an extra dollar. We don't have to build a new factory every time inflation hits. We just collect the royalty on human desire. In 2026, your lifeboat must be filled with these types of companies. Look for businesses with high profit margins and low debt. If a company is drowning in debt, the rising interest rates will swallow them whole. But if they have a cash-rich balance sheet like Berkshire Hathaway, they don't just survive. They go on the offensive while everyone else is panicking. Now, I want to tell you a secret that the wealthy understand, but the savers don't. While inflation is a tapeworm for your savings, it can be a turbocharger for your debt if you use the right kind. The Martinez family from part one stayed away from debt because they were scared. The Thompson family used fixed-rate debt to buy real estate. In 2026, if you have a mortgage at a fixed rate of 4% or 5% and inflation is running at 7% or 8%, the bank is effectively paying you to hold that house. You are paying the bank back with cheaper dollars. Meanwhile, the value of the house and the rent you collect is keeping pace with the new higher prices. You are using the government's own money printing machine to wipe out your debt. This is the only time in history where owing money on a productive asset can actually make you richer than having money in a vault. So what does the lifeboat look like in practice for 2026? If you have idle money right now, don't just dump it all into the latest AI hype or crypto coin. Follow the Omaha 100 rule. 140 to 50% productive equities. Focus on value and quality. Avoid the expensive tech giants that are now funneling billions into each other's pockets. Look for the consumer staples, the utilities and the healthcare companies, the things people must pay for to survive. Two, 20 to 30% real assets, REITs, or direct find properties in prime locations or infrastructure assets. These provide the inflation linked income we talked about. Three, 10 to 15% hard commodities. I'm talking about energy, industrial metals, and yes, a little bit of gold or silver. As crisis insurance in 2026, tangible is the new safe. 4, 10% inflation linked bonds. Tips, I bonds, these are the only paper I like. They are designed by the Treasury to rise as the cost of living rises. It's the only way to hold government debt without getting pickpocketed. 5 to 10% strike cash. Keep just enough in a high yield account to be able to act when the market has its next Minsky moment. That moment of panic when the idle money crowd finally gives up and sells their best assets at a discount. This is how you stop being the victim of the cycle and start being the architect of it. The person who reaches 2027 with their purchasing power intact isn't the one who played it safe. It's the one who is brave enough to stop holding paper promises and start holding real-world value. Everything I've told you over the last few hours is useless if you don't have the stomach to act on it. In 2026, the hardest part of protecting your wealth isn't the math, it's the social pressure. We are wired as human beings to seek safety in the herd. When everyone at the office is talking about their safe, high-yield savings account, it takes a special kind of courage to say, I'm moving my capital into productive assets. People will tell you, you're being risky. They'll point to the volatility in the markets and say, look, you lost 2% today, while I gained 0.01% in my bank. But you have to remember, volatility is not risk. Risk is the permanent loss of purchasing power. Volatility is just the waves on the ocean. If you're in a solid lifeboat, the waves don't matter. In 2026, the people who feel safe are the ones drifting toward the waterfall. The person who feels uncomfortable because they are doing something different is usually the one who is actually safe. And before we close, I want to tell you about the one asset that the 2026 debt crisis cannot touch. It can't be taxed away, it can't be inflated away, and the banks can't bail it in. That asset is your own earning power. If you are the best at what you do, the best doctor, the best plumber, the best content creator, the best teacher, people will always give you a portion of their output in exchange for your output. It doesn't matter if the currency is the dollar, the euro, or seashells. The best hedge against a $38 trillion debt isn't just buying gold. It's becoming so valuable to society that society is forced to pay you regardless of what the money is called. While you are reallocating your capital, don't forget to reallocate your time. Invest in your skills. Invest in your reputation. As I always say, the best investment by far is anything that develops yourself. We are heading toward what I call the 2000 to 27 crossover. This is the moment when the dust settles from the 2026 banking and debt shocks. On one side of that crossover, you will have the idle money crowd. They will be shell-shocked. They will realize that their safe $100,000 now only buys what $60,000 used to buy. They worked years for that money, and it was stolen from them while they slept. On the other side, you will have the asset owners. They will own the farms, the brands and the businesses that kept the world moving. Their net worth on paper might have bounced around, but their standard of living will have increased. They use the crisis to buy great things at fair prices. The difference between these two groups isn't IQ, it's temperament. It's the ability to see the tapeworm for what it is and refuse to feed it your life's work. The 2026 storm is coming. The clouds are already dark. You have the blueprint. You have the lifeboat now. All you need is the courage to step off the sinking ship. I've been betting on productive assets for 80 years, and I've never seen a better time to be a doer instead of a sitter. I'll see you on the other side of the crossover.